Understanding Child and Dependent Care Credit. The United States Child and Dependent Care Credit is a valuable federal tax provision designed to help working taxpayers offset a portion of the expenses incurred for the care of qualifying individuals. This credit acknowledges the financial burden placed on individuals and families who must pay for care services to enable themselves and their spouse, if married and filing jointly, to be gainfully employed or actively seek work. It is crucial to understand that this is a tax credit, not a deduction. This means it directly reduces the amount of income tax owed on a dollar-for-dollar basis, offering a more significant financial benefit than a deduction, which only reduces the amount of income subject to tax. To be eligible for this credit, taxpayers must meet specific criteria related to the person being cared for, the reason for incurring the expense, and their own financial situation. A qualifying person for the credit is generally defined as a dependent child who was under the age of 13 when the care was provided. It can also include a spouse or other dependent of any age who is physically or mentally incapable of self-care and who lives with the taxpayer for more than 1/2 of the year. Furthermore, the expense must be considered work-related, meaning the care was necessary to allow the taxpayer to work or look for work. The amount of the credit is determined by a few key factors: the total amount of qualified care expenses paid, the number of qualifying individuals, and the taxpayer's adjusted gross income. The maximum amount of expenses that can be used to calculate the credit is legally capped, and this limit is higher for taxpayers with 2 or more qualifying persons. Additionally, the credit has an earned income limit, meaning the expenses used to calculate the credit cannot exceed the earned income of the taxpayer, or, in the case of a married couple filing jointly, the lesser of the two spouses' earned incomes. The final percentage used to calculate the credit amount is based on a sliding scale tied to the taxpayer's adjusted gross income. Taxpayers with lower incomes are eligible for a higher percentage of their qualifying expenses, up to a specified maximum percentage. As a taxpayer's income increases, this percentage gradually decreases, reaching a minimum level for those whose income exceeds certain statutory thresholds. The mechanism ensures that the credit provides the most substantial relative benefit to low and moderate-income working families facing the financial challenge of care expenses. To successfully claim the credit, taxpayers must accurately report the care expenses and provide specific identification information for the care provider on Internal Revenue Service Form 2441, Child and Dependent Care Expenses, which is filed along with the main federal income tax return. The required information includes the provider's name, address, and their taxpayer identification number, which is usually a Social Security number or an employer identification number. Failure to provide this mandatory information, or demonstrating a lack of due diligence in attempting to obtain it, can result in the denial of the credit. This reporting requirement helps to ensure the integrity of the tax system and the proper verification of claimed expenses. We welcome you to subscribe to our YouTube channel for more informative videos on finances and taxes. Thank you.